Good afternoon. It's Happy St. Patrick's Day. It's March 17th. Obviously, we've been getting some calls, and I wanted to send out some information to help ease some of your concerns. Obviously, there's a lot of anxiety with the coronavirus and everything that's happening. And a lot of people have questions as to how that affects their investment strategy. Are they okay? What do they need to be doing? And so I thought what we would do is kind of just put together a short video with some information to help answer some of those questions. So we're going to start out a little bit about where we are today, and then we're going to talk through a little bit about some of the expectations moving forward, and also, how this may affect markets and things, because I think that's an important question that most people would like to know the answer to. Then we're going to get into some of the things that we're currently doing, and then our promise to you and how we'll work together to make sure everybody gets through this in a successful manner, because that's really what matters at the end of the day, right? So what I'm going to do is I'm going to show you, number one, some slides, right? So the first slide that I'm showing you, and this is coming from Goldman Sachs, it's just been put out, and it kind of shows gross domestic product. So that's a good measurement of our economy overall. And you could see in 2008 and 9, we had those dips, which everybody remembers, kind of a painful time. But then overall, this is kind of normal. You see that we have some ups, few downs here and there. But out here is kind of the projections moving forward for this year. So you can see that zero right there. A lot of people think this first quarter we're going to have a small gain or maybe zero for our growth. And that's from prior year, remember. And then you'll see a pretty big dip here of anywhere from 5 to 10% for quarter two. And a lot of that's due to us, being in our houses, not out and about, spending money, doing things. But then you can see after that, the expectation is we're going to have some pretty good growth following that up, right? So those are good things to keep in mind as we look through this. Now, one of the things, too, I'm going to bring up one more slide here behind that and show you something else that's really important. Let me zoom in on that a little bit and get to the big picture there. What you're going to see here is you're going to see that you've got this dotted line is Goldman Sachs, kind of what they saw happening this year before the coronavirus for gross domestic product and everything. And now the solid green line is what they anticipate moving forward, what it might look like, right? So you can see the actual end result is very, very similar. The difference is they did see a little contraction or slowdown in quarter two and then speeding up through the end of the year, which is pretty normal. But now they see this big drop, but then almost like a rebound in quarter 3 and 4 moving forward to kind of take care of that pent-up demand that occurs when we're stuck at home and can't do a whole lot for a little while. So I hope that kind of gives you some idea of what people think is going to happen moving forward, right? So as you look at those couple of slides, hopefully that helps you understand a little bit about where we are, kind of what the expectation is moving forward due to the coronavirus. And so one of the things we want to move into now is a little bit of what it means for the markets, right? So let's take a look, go back to our slides here. And I'm going to go on to our next slide. And what it's going to show you is, number one, no one ever knows day to day what's going to happen in the market, right? So that's something you always have to be aware of. But one thing we know is that you need to stay disciplined and you need to stay invested. This slide shows the power of staying invested over long periods of time. And you can see down here it says 9.96%. The U.S. market from 1990 through 2019 if you just stayed invested, right? So $1,000 over that period actually grew to $17,000, you could see up there. But look what happens when you start missing days. If you just miss the best day, it costs you almost $2,000 on that $1,000 investment, missing the best day, one day through that period of time. If you miss 5 of the best days, you drop down to $11,000. You get into 15, 25, and so forth, and next thing you know, your return goes down substantially, right? So that's one of the things we really have to be aware of as we're looking through these things, is making sure that we maintain our long-term return and not end up with a poor long-term return because we didn't do what we were supposed to do, which is stay disciplined, right? And here's the thing, that the true cost, if you look at studies, what it shows is when markets are volatile, like they are right now, we go through this cycle of emotions, which you can see. And, when markets go up, we feel good. Everything's like we get excited, thrilled. People are like, look at how much my account's growing. This is wonderful. But then when they turn, and we've turned a really quick corner, it's decreased in value very quickly, as most people have noticed. Anybody notice these emotions that a lot of people are feeling right now? Anxiety, denial, fear, desperation, even panic. We saw a lot of panic selling out in the markets recently. Capitulation, when you give in, you say, I'm going to cash because I can't handle it anymore. And then what happens? Things get better. They always do. So you start going from depression, hope, relief, optimism, and the cycle continues. Well, here's what we know over on this other side of this slide is that, this gives another time period of 2007 through 2017. And what we know about that is that, the basic thing you have to remember is when you look at those things, the investor that stayed disciplined through that long period of time got a really pretty good return, about 8.5%. But the person that couldn't do that, on average, only got about 4.88. It's almost cutting that return in half because they allowed that cycle of emotions to affect them, right? So that's what we're trying to avoid in this case, is not get caught up in what's happening day to day, but instead focus on the long-term return that we can capture through that, correct? So that's real important, right? Let's move on to our next slide. And this is something that I think is really important to understand, because one of the things that people I don't think really know is that, believe it or not, about 52% of the daily returns in the markets are positive, which means 48% are negative. Almost half the daily returns are negative. So if you watch it every day, it can get really crazy and really depressing sometimes. Only 56% of the weekly returns are positive, right? So we've got a good share, almost half the weekly returns are negative. On a monthly basis, 59, quarterly, 63. You get into 6 month and longer, you start seeing that you're much more likely to have a positive return, which goes back to the perception when we watch it over short periods of time is that it's always negative. The reality, when we get into longer periods of time, it's pretty much always positive. So it's super important to focus in on that and not get caught up in the short-term thinking that, hey, it's going to be bad forever. Because when we go through these periods of time, it's really easy to think that. So we have to always keep that in mind, right? And here's one of the other things I always talk about. Markets always reward discipline. So you can see all the different things that we've gone through the years. This goes back to 1970. I mean, you can read the slide. There's a ton of different negative things that have occurred. But guess what? That dollar from 1970 till now has turned into $69 for all the good and the bad. This is what we want everyone to achieve, that long-term positive return. And the hard thing about that, it means you have to stay disciplined and you have to stick with it, right? So that's important to remember. But this is what we're trying to achieve. Always remember that. So let's talk a little bit about what we're doing and what you can do when you have down markets, right? So some of the things that we do, and it adds a lot of value long-term, is rebalancing. So everybody knows one of the core values or the core things you should do in investing is what? Basically buy low and sell high. But unfortunately, most people do the exact opposite because they get caught into the cycle of emotions and want to invest when times are good and want to pull out when times are bad. Well, when you rebalance, like given this prior period where we had a quick market downturn, that means that if you had a 60% stock and 40% fixed income portfolio, now the stock position is below targets, because of that downturn. But now the thing is the fixed income positions have gone up, right? They've actually had a good return because people rush to those positions and it pushes the values up in the short term. So when you rebalance, you're getting back to that target, which means selling off some of the fixed income and then buying into the stock position. So what have we done? We've automated a process where we sell high and then we buy low because the stock positions prices are down right now. So that's one thing that's a real positive when you have down markets. The other thing that we do is we look at taxable accounts, so non-IRA accounts, and we're determining if we can get some tax advantages. So if there's been some positions that have gains or losses, we can sell those, and it's just called tax loss harvesting. And we can sell and put those losses in our back pocket. We stay invested, right? We replace it with a similar position, so we're not out of the market to enjoy those recoveries. but we have that realized loss now in our back pocket. So when the market regains, we can use that to offset gains for a net zero tax. So that's a real important thing. Another thing is, as cash is coming in for people that are contributing on a monthly basis, that money's getting invested right away. We're not sitting on it because the market's down. And that's how you realize the benefits of dollar cost averaging. We see people sometimes that stop contributing to 401ks because markets are bad. Understand one of the best times to be putting money in is when the markets go down, because your future expected return is much higher. So you have to remember that, right? And so a couple of things that we want to just promise to you through this. Number one, we are here for you. We've cleared our calendars. Brent and I are both available to talk. So if you're feeling a lot of anxiety and just want some reassurance that things are going to be okay, give us a call. That's what we're here for, right? The second thing is that we are going to, effective today, we're not having in-office appointments for the short term, just as a precaution and on the recommendation of the state. You know, we don't want people coming in and out and with the possibility of spreading the coronavirus. So we're going to stick with virtual meetings and also phone meetings. But those work fine, and we're still here available for you. And one of the other things is I'm going to regularly be sending out some of these videos with some information to help you be successful. You know, the number one thing in a lot of things in life is discipline and patience. And if we can just stick with those two things and stay with it, we're going to do okay. We're going to get through this, and we're going to see those positive returns come in the near future. And oftentimes those positive returns come before the economy even gets better. And it's just because markets look ahead. You know, they're not stuck in the moment like we often are. And one of the last things I want to share with you, and this is our primary goal, and we call it the behavior gap. So when you look at this, this is what we really want to avoid. We want to make sure your return is the same as the market return. We do not want to do things to self-sabotage, like selling when the market's down, pulling out, doing all the things that we know lead to poor returns. So this gap that exists, called the behavior gap, is what we can control. The markets always over time provide a competitive return. It's just that we oftentimes can't stay with it. So as you look through that and you think about the behavior gap, think about, hey, this is really about us staying with our plan. We've got wonderful tools available. If you really have a lot of anxiety, we can see how you're doing as far as the score of your plan. So don't hesitate to reach out. We're here for you. We want you to have a great amount of success, and we will get through this together, and things will get better. Signing off, but again, expect to see some other videos from us in the coming days to go over further information about markets and what to expect in the future. Thanks so much.